What was the why behind the call and the melt up to 3,400?
Hello, hi, morning. So the melt-up scenario of 3,400 for us corresponds to a scenario where everything goes right. So for the good news on U.S.-China trade war, investors pricing the fourth mini cycle, as you were mentioning, and soft data to bottom out. Why we're still in the context where positioning sentiment indicators are not showing any signs of complacency. But more broadly and more importantly, I think we're underestimating the search for yield environments, which is key for this economic cycle. So we're facing this 12 trillion negative yielding debt, slightly shifting the nature of assets and how investors are tackling with their asset allocation. So if you look at S&P, it's yielding 5%. So 2% dividend yield, 3% buyback yield, when you have 10-year treasuries at 1.7%. And you also have our U.S. equity risk premium really high, enhancing the relative attractiveness of equities versus bonds. So we think the melt-up is possible, but not sustainable.
So, Sophie, as we head, though, then into 2020, I mean, we have the Fed support, and we also obviously have a lot of support from other areas. When you look at earnings and some of the more fundamentals that we would typically expect to support stocks, what's your outlook there, and how is that going to change your forecast deeper into 2020?
Yeah, so for the S&P profile, we expect a V-shape. So basically, in our mild recession scenario, where our in-house scenario resting on the assumption of two quarters of negative GDP in Q2 and Q3, with an overall year around plus 0.7%, according to our U.S. economists. So in this context, we expect only 10-15% drawdown, which is nothing compared to other cycles, because of three reasons. P expansion to be supported by further cuts and balance sheet expansion. Earnings recession shallower than in previous cycles because of this mild recession scenario. But more importantly, we still expect 600 billion buybacks, which is a significant support for S&P next year.